Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone, and thank you for joining us for this session with Fettke. I'm excited to have her on. She's very inspiring to me and to a lot of women and men alike. Because she's just done phenomenally in real estate, and she's appeared on so many media channels. Like I mentioned, she really digs deep and asks all the right questions about investing, not just like a superficial one. I know she's very much into data, and today I'm excited to see what she has in store for us as far as the data surrounding the housing forecast and real estate forecast looks like. A lot of my investors, the reason I wanted to do the session was a lot of my investors and everybody out there is in a state, they're in a state of panic, and the minute stock market goes down and crypto goes down, and we see some changes in that market, like we get into the bear territory, I start seeing a lot of shift in real estate as well, right? Obviously, the interest rates have pushed real estate from a price standpoint. I am seeing some correction in Austin. I'm seeing a strong correction maybe in some other markets, but not a huge correction really, more a slowdown. And personally, I believe we needed a slowdown. I don't like this idea of like this escalating market for the last 12 years. So I don't think recession or at least a pullback is a bad thing, and it's literally been forced by the increase in interest rates as far as I'm concerned. So I'm excited to see what Kathy has in store for us from a data standpoint, and hope that this will reassure you, because I think a lot of my investors, at least Kathy, I don't know what you're seeing, is that they are expecting another 2008 to happen. And I don't think we are in that market anymore. So they just feel like, oh, there'll be this huge crash in real estate and there'll be great buying opportunities again. So let's just pull back and wait. So I don't believe that's going to happen, but I'm excited to see what you think or your data shows us. As always, this is just based on the data. We know this is educational. We don't know the future. We can only extrapolate based on data that we have. So please don't take this as, take it with a grain of salt. Make your own decisions in your investments based on your legal advisors. Just a quick housekeeping items. Apparently chat doesn't work today, so we're going to work with Q&A. So the good thing is I like people asking questions in the Q&A box and not in the chat box. It makes it really hard. And today we don't have to worry about the chat box, so that's great. I get at least 5 or 6 emails about when will I send the recording. So I'm going to answer that right now. It'll be within 24 hours generally, and it'll come. If you're registered for the webinar, you will get the recording. And if you want to avoid it from going to spam and promotions, please add my email to your list. I don't want to go through all this. A lot of people know me already. So hello, I run Cherry Street Investments, work mostly on educational webinars like these ones across alternate investments, taxation, estate planning, and other topics. I help put together passive investments in real estate through syndications, apartments, senior living, and land developments are some of the asset classes that I'm in currently. I also am a realtor in the Austin market, although I'm not super active there. I'm also a life insurance broker. I focus on what's called infinite banking or infinity banking, if you're familiar, where you set up high cash value policies to use as a tool for investing in real estate and other investments. If you're interested, you can join our Facebook group called Purely Passive Investor Group. And if you're ever looking for previous webinars that I've done, there are about 100 plus of them. You can go to Cherry Street Investor Education on YouTube. And please subscribe to my channel so I can grow my audience. You will also get auto-notified when this content from today's webinar goes into YouTube. You'll get notified automatically if you're subscribed. The short link for the YouTube channel is bit.ly/cherry-street. The upcoming webinars, we have how to become a better and more savvy passive investor with Ashley Wilson. Again, Ashley is one of the superstars. She is a big part of Bigger Pockets, and she works with Bigger Pockets, Jay Scott as well. They have a company called Bar Down Investments. She's super smart, super sharp, and she's been investing or organizing apartment syndications for a while. So I really like the content she's putting out there for passive investors. So I'm excited to have her on. We'll also talk about senior living investments in a couple of weeks. If you have any other topic suggestions, please let me know. A lot of folks, again, on the call know me already. I'll skip this part, mostly working on real estate investments. I'm financially free. I was in tech before, now full-time in real estate. Just do a whole bunch of things around real estate. This is some of the properties that I have and my investors are invested in. I'm just going to talk about the star of the show, Kathy. Thank you, Kathy, for being on here today. I'm really excited to have you. She is a real estate developer, a fund manager, and an awesome educator. She's routinely on every conference that I look up. Kathy's speaking, so I'm excited that I was able to grab her time today. She's a super busy woman here. She's a regular guest expert on Fox News, CNN, Bloomberg, NPR, and was also named the top 100 most intriguing entrepreneurs by Goldman Sachs for 2 years in a row. So just excited again to have her on. As the host of Real Wealth Show, this is a featured podcast on iTunes. Please go to iTunes, check out her podcast. She interviews a lot of successful real estate investors to share their secrets. And there's a lot to learn here from other people, right? Why recreate the wheel if someone has done it already? She's author of bestseller, Retire Rich with Rentals. Is that available on Amazon, Kathy?
Yes.
Awesome. Yeah, check out her book. And Kathy and Rich are like among the most active people I've ever seen. They are just it's amazing, you know. They're not just active real estate investors; they are just simply active people, right? They are rock climbing. They are what is that called, Kathy? What did we do when we were there?
Rappelling,
surfing, and super active people, and just super inspiring as well. So definitely follow Real Wealth Show and the podcast as well. And I'm going to hand it off to Kathy to share her screen and start today's presentation. Thank you, Kathy, again for being here.
Thank you. Okay, I'm going to see if I can pull this off. It says, oh yeah, there we go. Where's that PowerPoint? Why do I not? There it is. Yes. Okay, and I'm not on the first one. There. Okay, you can see it?
Yes.
And still?
Yes.
Okay,
perfect.
Good. Okay, wonderful. All right, so this will be fun. I'm going to talk about something where there's a million different opinions. So we'll see what comes out of it. With the mid-year housing update of 2022, I put this picture on there because Rich and I do surf, and this picture sort of defines what's going on right now. Just energy coming from all over the place. So it's very hard to navigate. I wouldn't want to be out surfing in this water because you don't know where the wave is going to come from and it could knock you over. And that's basically kind of how people feel right now is how do I do this? So here's my disclaimer. I'm keeping it real simple. Don't sue me. These are just my ideas. You can just use them to do your own due diligence. So what we have today is a lot of scary headlines, but that's nothing new. That's the business. I have my degree in broadcast communications, and I worked in many newsrooms as you know, and I know that the job is if it bleeds, it leads. So there will always be scary headlines. This is intentional so that they can sell advertising. Not a great business plan, but that's what it is. So let's just look behind it. This is a typical headline. I'm going to move our photo over so I can see. This is a typical headline that you'll see Keep an eye on these overvalued housing markets as the housing boom implodes. So, that's in Fortune. So when you see that, of course, people are going to freak out. Nobody wants to be in an imploding market. But then when you basically, wait, why is this not doing this? Oh, there it is. When you read the actual article, and please read the articles, just don't listen to the headlines because they're really just meant to have you read the article. And that's where in this article, this imploding housing market is prices going up 5.9% this year. So that's pretty phenomenal implosion, if you ask me. That's a normal increase in prices. And, so there's a lot of dramaticness out there. Another one, here's this realtor who on Twitter is basically saying, the pandemic real estate frenzy's over. Available inventories up by 5.7% this week. So it sounds like it's tragic and scary. And you might look like this woman going, what do I do? But then when you pull out and look at the total inventory, and I'm talking about US single family homes right now, but that does affect multifamily and all sorts of things. So here's that massive increase in inventory. And I think we're all going to die because of this slide. So I just want to make sure you know that its inventory is still so low that we don't need to worry. So when we ignore the headlines, then we've got to say, well, what's the reality? What should I really be looking at? And this is a great slide. This is the housing inventory is down so low, way below where it should be. I think we're still under, a million homes on the market. So that's not going to work, especially if you want to compare today to the last housing recession. You've got to remember there's nothing similar about it. There's 14 million more households today. Our population is growing. So that's one thing to keep in mind is there's more people. Our population is growing. You'll see headlines how it's slowing down, and that's true. The rate of growth is slowing. And when you look at this chart, I would say, thank goodness, we can't have population growth just go off the charts. So the growth is slowing. However, we're still growing as a country. And particularly of interest is this 21 to 38-year-old millennial group. This is why they're in the news all the time. We used to, people in the baby boomer age group used to be the group that would really impact the economy. And now they're declining. I don't really want to say why, but they're getting old. But over here, we've got the millennials who it's a huge group of people, 82 million, with the largest of them just entering household formation age. So this big lump right here, and this big lump of people is basically age, until for the next few years, they're going to be going through this first time home buying age, first time forming households, getting married, having babies, wanting more than that little studio that they had downtown before, or having 16 roommates like in college, or however many they did. So this big population is hitting a peak right now, right when we have those inventory shortages. So as we've said, and you've seen these headlines, there is a shortage of housing. Nobody knows exactly the number. You hear 2 million, 3 million. This article said 5 million. What we do know is that there is a tremendous, will builders be able to come and meet the demand with more supply? Can builders build enough to solve this problem? And when you look at this new home lot supply, doesn't look good. There's just not a lot of ready to build lots out there. The new subdivision count, look at that. Historically speaking, it's just pathetic. There's, builders are scared to build, and for good reason. They're getting hammered right now again, 10 years later. We syndicate subdivisions. So I could tell you firsthand, it's been brutal to try to get through this pandemic years building homes when you can't get the supplies, you can't get the labor, you got to shut down your entire job site. If one person tests positive, everybody comes back to the job site, someone else tests, you shut it down, you go to the city to get your permits. You guys have been through this. You can't get the permits because nobody's there because someone got sick. It's been so difficult. So yeah, the builders are not really excited about bringing on a whole lot more inventory. So here we are with new listing count way down. That orange line is 2021. It's a third of the amount of inventory that was around in 2017. Then you look at 2018, 2020 is when it really started to decline. And 2021, when there was this buying frenzy with this huge group of millennials and everybody else buying, not just the millennials with interest rates at 2-3%, everyone was buying. So there's just not much there. Not to mention that people are aging in place, living longer, staying in their homes, buying 1 or 2 or 3. So again, huge inventory shortage. And again, the problem that builders are having, besides just everything I just said, is getting the supplies, and that's driving prices up. So now with interest rates up and material costs up, it is really, really getting difficult for builders to make things work. So I don't see a resolution anytime soon as far as bringing on new supply. These are the types of things that are making it very difficult to even get your CO on a home or on a multifamily. Garage doors, this isn't something 2 years ago anyone would have even considered would be an issue. 40% of builders said they couldn't get garage doors. And in our subdivisions in Reno and Bozeman and Tampa, we literally had to get vans and drive to like Denver to pick up garage doors, and that's the same like windows and HVAC. Like it's so trusses, our Florida team out there, they could not get trusses, and you can't build a house without them. I mean, you could, but it's pretty tough. So now our latest in our Park City project is cement. Again, something that you wouldn't think that concrete would be, that you'd have a shortage of that, but that's what we're experiencing in our Utah project. So things that you just really couldn't anticipate, and that is definitely slowing down new supply. Again, at this time when there's household formations. So this slide shows how single family and multifamily housing, what are you going to do when you have limited supply and this demand? You're going to see, this long slide's out of order, but we're seeing, migration still to certain areas. The bluish ones are where there's just massive migration still. So you got, migration trends and lack of supply and great demand. And what we see is, of course, rent growth. Even now, when people are so concerned about a housing crash, these are the kinds of headlines that this is what it is. Rents continue to rise. Not in every area. There's certain areas, like you said, in Austin, there's a cap to how much people can afford, right? And got to be super careful about that and really aware, because I know personally, we've seen a lot of deals come across my desk where people are pushing rents, and I'm not so sure they're going to get them. I can't say for sure, but you've got to really understand the market and, can people afford another push in rents after there's already been such massive increases?
Especially as incomes are not going up at the same rate, right? There's a top limit to the affordability.
Yeah, absolutely. Again, here's some areas: Orlando with rents going up 51%. I mean, that's just wow. Miami, those are the hot markets. Toledo, Tampa, Las Vegas, Atlanta. These are places where rents have gone up so much. And anybody here who sold an apartment building in the last year, congratulations, because I can't even imagine how much money you've just made, because these are the kinds of things you don't see. It's a pandemic response and a response to this group of people that are looking for a place to live, but it won't be forever. So that tends to be, people get kind of caught up into, oh my gosh, I love this momentum, but it doesn't last forever. But we have seen single family home prices showing double-digit increases. Of course, that. So inflation in food, then add to all of the issues with COVID for the last 2 years, and then a war breaks out in the one place that's considered the food basket of the world, in Ukraine. And so, of course, on top of everything, food prices going up and energy costs going up. So and this happens when there's still massive job openings. So when people say we're in a recession already, or we're definitely going to be in one this year, these are the kinds of things that are most important to pay attention to, because when you have this much job growth, how do you have a recession? If somebody loses their job, and you're going to see headlines of people in the mortgage industry losing their jobs, people in real estate losing their jobs because they're not able to sell houses and nobody wants to refi. I mean, come on, that business is gone for a little while. So you're going to see layoffs, and that's going to make headlines and freak people out. Then you have to turn around and see this and say, well, they can go get another job. There's 2 jobs for as many people that need them. So it's actually almost needed for people to lose jobs, because if people lose jobs, then this will change, and there'll be enough people for the job openings, and that will help relieve this inflation problem. Because when employers can't get employees, of course, they have to increase wages, and that is passed on to the consumer in the form of, more inflation. So this is an old story. We've heard it for months now, but inflation is on a tear. The Fed is probably going to do another 3/4 point hike, just probably next week. And when that happened last month, there was, a shock to the economic system, because these kind of rate hikes aren't normal to do them this big. So we're gonna hear it all again next week. You're going to get a whole lot of fear-based headlines. But one thing to look at is, this is what everybody's freaking out about. The Fed fund rate will probably be at 2.5% next week, but this is where we were just a few years ago. In 2018, this is where we were, and we all survived it. I want to remind you all, we all survived the rate hike that's about to happen, because right now it's at, I think, 1.5, 1 3/4. They're going to do another 3/4, 75 basis points, and get to around 2.5%. Then there'll probably be another one after that would take us to 3. But when you look historically, we have extremely low rates. And one of the reasons that the Fed really can't continue to hike rates is our $30 trillion national debt. The US would literally default on our debt if rates went too much higher than that. A lot of people say we're going to experience another situation like the 80s. It's just, I don't see it happening. I also didn't see COVID happening, so I'm not always right, but it's just important to know that we are in a situation where it would be very, very difficult to raise rates too much, because, again, the government would default, and they don't want to do that. But with that said, the economy has been historically sensitive to rate hikes, and with hikes this fast, there is concern that that the Fed won't get it right and we'll end up in recession. So it's certainly something to watch. We know it's working. The whole point of raising rates is to slow down the economy. So when you see headlines saying the economy's slowing, you just go, yeah, right, that's what was intended. And a slowing economy means that there will be job losses. Now, in an environment where there's job losses and no new job to get, that's not great, but we're not in that environment today. So I personally think, and I'm sure a lot of people here agree, that the biggest reason we have inflation today is the quantitative easing that the Fed does, that just the reckless printing of money. And we know that in March of 2020, wow, they went off the rails. This came off the Federal Reserve's website, the press release, that the Federal Reserve is committed to using its full range of tools to support households, businesses, and the U.S. economy overall in this challenging time. So the way that they did that, they increased the money supply by 40% or more. That means that all the money in circulation in the U.S. was 40% more than in 2019. So if you have that many dollars circulating that are fresh and newly minted, you're going to see an impact, and just like they wanted. You're going to see businesses up and running and wanting to hire, and people wanting to buy houses and now wanting to travel. The savings rate is high. So they overshot on the stimulating of the economy during the pandemic. And now they have to dramatically and aggressively try to fix that. It's a little concerning. I think it's interesting, and you could have all kinds of conspiracy theories about it, but the Fed is basically the banking system. It's not the government, it's the banks. And you would think that maybe they might, if I know some of this stuff, and I don't have an economics degree, they are tasked with managing inflation. And I think anyone here might know that if you increase the number of fake dollars on the monopoly board, but don't increase the number of assets on the monopoly board, you're going to see prices go up because there's more dollars circulating. So interesting times that we're in. Every decade has something unprecedented, honestly. So I guess it just goes with the territory, but it is, like I said, energy coming from all kinds of places, and it's hard to know what's next because we haven't been here before. But I can tell you what I think. When you look at this chart which is the M2, it's the money supply. Again, that's pretty unprecedented here. This increase in money circulating that they just print, out of thin air. We know that in 1971, Nixon took us off the gold standard, but the government and the Fed were still pretty conservative about printing money, and people would get a little sensitive when they did, and there'd be headline news and stuff. Then, man, after the Great Recession, that's when they just went crazy. After 9/11, there was some quantitative easing of not very much. It was a tiny amount, as you can see here, and that made headline news. But after, you could see it's just been a way of life now, increasing the money supply. So now trying to pull back some of that. Again, it has caused recessions in the past, but according to Marcus and Millichap, that they have some great videos that you might want to watch. A lot of interesting things there. It hasn't, you see the CPI inflation and Fed fund rate inflation, they're going to keep raising to bring this down. And will it work? We're already starting to see things slow down. So it is working. It is working, but will it work in real estate and housing? Given what I said, a limited supply and so much demand, that's yet to be seen. And let's see, what is that? Yeah. So historically, during recessions, housing isn't that affected, and commercial real estate, depending on what asset class you're in, isn't as affected as, say, the stock market or businesses that are starting to see less sales. But because there's so many headlines with people freaking out that it's going to be another 2008, when you have the data and you see that's kind of impossible, it's impossible. 2008 was a credit bubble. People were given loans just for, you signed your name and you got a loan. There was no qualification process really. I was a mortgage broker. It was so easy. You hand someone an application, they tell you how much money they make, and you take them for their word, because that always works. So that's how it was. And you could have 10, you could have 20. There was unlimited number of investment properties you could have then. So, it was the wild, wild west. That's not the case today. When Dodd-Frank laws came in, and as you know, it's hard to get a loan. People who own real estate, people who own their primary residence today are in the best shape of a homeowner almost ever, because they're locked into historically unbelievable low rates, 2-3%. They have massive amounts of equity. They have little tiny payments compared to rent. They're just going to give their equity and their low rent to the bank and say, "Here, take my house. I don't want it." That's not going to happen. They're the strongest today. So the idea that all of a sudden there's going to be this massive inventory out there, the inventory that is starting to get repriced is basically people who were enjoying, this ride up, but the properties weren't necessarily worth what they were selling for, but they were selling, so why not? Then if your neighbor sold for this price, you're going to list yours a little bit higher, and bam, someone buys it. Okay, so the next person. So it was, people who bought in the last year may have overpaid, but again, those people, are they going to just, they bought their house for a reason. They probably want to stay there and live there. So they're not going to just pick up and leave. If they bought it for a rental, well, there's massive demand for rental. So, again, the idea that there would be a housing crash, it's really hard to imagine that that's possible given those circumstances, that, you would, instead of just putting your house on the market, you're going to go into foreclosure and not take the equity that you earned over the years, and then buy a new house or that's a much higher, double the payment that you have, or rent that's maybe double, what you're paying. So I don't see it. Again, this was what I was saying earlier, that we're not sure how high the Fed can hike rates because of our national debt that's just really out of control. So with all of these factors, if they can't raise rates to slow down the economy, they're going to find different ways to do things. And one of the ways that has become very handy for most countries, it's not just the US, it's most countries that have a central bank, they're like, well, we'll just print some more. If we got to raise rates to slow down the economy, we'll just print a little bit more money to pay the interest on the debt. We'll just kind of handle it this way. So this is this new way of dealing with money that is really a Ponzi scheme. If you ask me, it's really a way to steal from the poor. I hope this isn't going to any authorities or Twitter, but this is the new normal, which is the modern monetary theory. And you can look that up and see this is what's been adopted. Japan's been doing it. It's just, we're going to solve our problems by printing more money. Now, I think my 3-year-old, grandson could figure out that's probably not going to work, but that's what we're doing. And what that translates to is generally dollars find their way into stocks and real estate. And the people who get hurt in this kind of environment are those who really already were living on the edge. They're already maxed out their budgets. And then printing more money creates more inflation and life becomes harder. So, I've been on a mission to help as many people acquire an investment property or a primary residence for years, knowing that this is the environment we're in. Like, if you don't own an asset, you're going to be underwater. You're going to be struggling just to survive because inflation is here. And it's not going away, and there's not much they can do about it, sadly. And it's been happening for a long time. This is the M1 slide. Everyone tells me to use the M2, but I like to show this because it's just shocking. This is money in the economy. And again, this is inflation. So you see, it's not new. Inflation ever since 1971, when we went off the gold standard and governments could just go crazy with printing money to, get reelected because they could give constituents what they want. Well, this is what we got. Inflation is here. So really what we have today is a perfect storm. It would be an even more perfect storm if rates go down again, and they probably will. Because as the economy slows, then the Fed reverses again and needs to stimulate it again. So it wouldn't be probably for a couple of years, but we'll probably see rates go down. But in this moment now where there's all this fear in the air and things are starting to get repriced, it feels to me a little bit like 2 years ago when people were so scared at the beginning of COVID, but people who kind of see the fundamentals weren't scared and kind of jumped in and took advantage of really great opportunities. So if you were able to find great opportunities, there's a chance, I'm going to say a pretty good chance, in my opinion, that you'll be able to refi and get a better loan at a later date. And even so, at least in the housing, single family housing world, rates are still low, historically speaking. It's the rate of change that has people so shocked. As you can see, that's fast and furious. Just this year for rates to double is, of course, there's sticker shock. But when you really pull back and say, oh my gosh, well, this is a very low rate still, people will adjust and they will, especially now that we're starting to see some price declines, people will jump back in because the fear of inflation is enough to have you want to lock in a mortgage or a rate and not have to deal with rising rents. So people will get back in. They just have to adjust to this concept of a 5% interest rate, which, as we know, you look in the past, is pretty normal. All right. So let me move this. I can't see my screen, so I have to move this thing. One of the things that we're seeing, and I think is really important for people to understand, for us to understand as investors, is that the U.S. still looks really good. It looks better than a lot of places right now. Europe is having a huge challenge thanks to the Russian war, and returns here are better than kind of anywhere, really. So you could see the commercial real estate yield there. This is thanks to Marcus and Millichap, higher than many of these other options. So we're seeing a lot of foreign money coming into the U.S. as a result of the stability that investors are seeing here in the U.S. When you compare returns here to other countries, we just outperform. So money's coming in. And as a result, we have foreign investment back. It really slumped in 2020, but 2021, it came back. In 2022, it's on a tear. So, foreign money coming back in. If we're not going to buy it, someone else is. So how do you navigate this? I'll just give a quick story. And again, this is single family. This is when Rich and I started investing out of state. And we knew that there was trouble in the high price markets, the markets that had already boomed. Any market that's gone up 30, 40%, that's not sustainable. And they're probably going to see a pullback, which is happening in Austin, happening in Seattle, Las Vegas, parts of Florida. That there's going to be a pullback when things get out of control like that. Never jump into a market that's already done its thing, So back in 2005, I had Kiyosaki on my show, and he's the one who kind of explained this to me, that once prices get up too high in the kind of sexy markets, the sand markets, then people move elsewhere where they can afford to live. And so this is what was happening at the beginning. In 2005, he said, sell everything in the bubble markets because they're going to slow down or decline. And he was very right there. And get into the markets that haven't done that. They didn't see the growth over the last, back then, they didn't really participate in the housing boom. But they were participating in a job boom and a population boom, that the home prices hadn't gone up yet. So for us, we went and we could get, those easy loans. Rich and I just went and bought a bunch of really beautiful houses like this. They were $120,000 to $140,000. They rented for about, $1,400 or so. So they cash flowed. It was just a safe way to kind of stay out of the storm and have really quality investments that people would want, even during a recession. And sure enough, throughout the recession, these properties stayed rented because when there's foreclosures, people still need a place to live. They need a place to rent. They stayed strong throughout the recession. We helped thousands of people do the same thing at Real Wealth, and those people didn't feel the recession that so many markets were. And the story is that every market behaves differently, and usually in a downturn, it's the affordable markets that outperform the bubble markets. So we learned that. We also learned that cash flow is king. You all know that, but I'm seeing a lot of deals, and I don't want to give out any names, but I'm seeing a lot of deals come across my desk where cash flow is not there and they're really pushing rents. So I kind of think a lot of these deals are negative cash flow, honestly. And I can deal with a negative cash flow in a single family, but I'm not doing it on a multi. So you got to be careful. I mean, really dive in deep, look at the assumptions that are being made on these multifamily, and make sure you have a backup plan and a stress test on it in case you can't get those rents. What are you going to do? Do you have enough money in reserves? Which brings us to reserves. This is a time to be very, very careful and make sure you have lots of reserves that can help you out with your stress test scenario. If that scenario ends up being the situation, you're fine. You have reserves. Don't over leverage. I'm a little more conservative. I'm a lot more conservative these days because I've already been through this cycle. I already know what it feels like. It's awful. When you get it wrong. So, and believe me, we're struggling with our single family home developments because it's like, oh, it's been so expensive to build stuff. So here I am again, just in a different asset class, but don't over leverage. This is the key in multifamily. I'm so conservative. I'm keeping my LTVs at 65. I don't want to deal with stress. Financing can disappear. So any of those bridge loans, one big lesson we learned from the last recession is when money comes back out of the system, when the Federal Reserve's trying to pull out some of the money that they put in, which is what they're doing now. Sometimes banks just go out of business, and the financing and the stuff that you were able to do just a year before, you can't. Credit lines just disappeared. So you thought you had a credit line as a backup and it was just gone. Even construction loans, you'd be midway through a project where you were approved on a construction loan and it just wasn't there. I'm not saying that's going to happen this time around, but just be aware that it's better to be in a long-term fixed rate loan in this kind of environment.
Yeah,
and then of course,
happy to speak to that. I can tell you the last 2 months in multifamily, we have seen so much change on the lending side. Lenders are cutting the proceeds, they're just pulling back big time. A lot of lenders, like you said, are already disappearing. They're like, they were there literally 2 months, everything changed, 2-3 months. It was just like that as the interest rates went up. So yeah.
It's fast and furious, and they're doing it on purpose and trying to, the Fed finally admitted their mistake, but to most of us, it was so obvious. Like they were buying mortgage-backed securities until this year, trying to keep interest rates low to stimulate the housing economy, the housing market when prices had already gone up over 20%. It's like, why are you trying to support the housing market right now? It doesn't need it. Right. So they just goofed, which is concerning. And then of course, staying in the right markets. So this, I wanted you to see this, that the most recent recession, well, COVID is kind of one, but it was a weird one. Housing was not affected. It took off. You can see from this slide. There's an example of how housing can absolutely go through the roof even during a recession. Now, the one that really wiped a lot of people out was the most recent one. So that's an open wound for a lot of people. And that's the one they focus on. But nothing is similar to that right now. It's not a bunch of people with 100% loans, that they didn't put any money down and are interest only and qualified with a pick a pay. It's, none of that is true. These people had to put down payments. They had high FICOs. Now they have tremendous amount of equity. So it's not the same market, but it's the one people remember. But when you go back to prior recessions, which are all these lines, look at housing. You're not seeing that dip. So yeah, it's different. But what we do have today is a big shift with home prices having gone up so much, and now interest rates. And this is kind of the story really for apartments, is that now it is just cost prohibitive to own for most people. So they are forced to rent. And this slide shows the difference between a home payment and an apartment rent. So all these people who thought maybe this was the year they were going to buy their first house, sadly, it's not going to happen for them, and they're going to be renters until we get back to a scenario where it's not as different. But the bottom line is, if you're worried about a recession, and there's, everyone is, right? There's a lot of reasons. Logan Motoshami of Housing Wire says the five out of the six recession red flags are up. So yeah, it's really looking like we're heading to one. But then you see things like this with monthly job gains, with an average of 488,000 new jobs. I mean, you don't see that in a recession. So this economic indicator is telling you the complete opposite, that we're in a bustling market. You got people that have been locked up in their houses for 2 years and they want to party. And everyone I know is in Europe. Everyone's traveling, they're eating out, they're going out. That's not a recession. That's people getting out of the house and spending the money they saved during COVID. So that means employers have to gear up and hire people, and there are jobs. Now, will that fizzle out? It will. It will. All that excess money that's been saved, they're going to spend it. But in the meantime, not anytime soon. So the unemployment rate is still, look at just an incredible V-shaped recovery, not even a V-shaped, a Christmas tree or something. I don't know what that is, but it just, massive job loss. People thought we were going to be in an extended depression after that, and the bounce back is phenomenal. Again, it has a lot to do with adding trillions of dollars to the economy. I'm sure that helped. But then you've got hourly wage growth. It's people are getting paid more, not anywhere near inflation, but wages are up. And this is the big one. This is the one that people didn't expect, is this retail sales. There, people are spending money. And again, that doesn't happen in a recession. It could change, but you're not seeing it right now. On the flip side, here's the issues again, is inflation is not under control yet. But what's really affecting these numbers more than anything is oil and food and housing. And otherwise, it's, and food and oil, that's out of our control. The Fed rate hikes aren't going to do anything there. But housing, yeah, the increased interest rate will probably bring that part of inflation down a bit. But what is probably the thing to pay attention to is this consumer confidence index that's just dropping, and it has everything to do with the headlines and people being scared and thinking we're in a 2008. And if people are feeling scared, they could create their own recession by not spending. Again, we're not seeing it yet. And this slide should give some people comfort, because this is how, again, commercial real estate has performed in past recessions. This last one, not affected. Of course, the 2008, pretty deeply affected, but, look at some of these past recessions, not so much. So when talking about markets, here are some of the areas where we've seen the highest job growth, where they have more jobs now than before the pandemic. These are the hot markets. Again, how much you can push rents up in these markets is questionable, because it already happened. But these are definitely the markets that have had the strongest job growth. And this is an interesting dynamic that may or may not change. It was certainly a pandemic thing, was that people, and this is from Zonda, people from Washington, D.C. that were thinking, okay, I'm going to relocate, it's time. And they go to look at Jacksonville. That tends to be where a lot of people are moving from, places like Washington, D.C. In 2020, they would look at Jacksonville, and it was 47% cheaper to live there than in Washington. Now, with prices up, it's 38% cheaper. So if this migration pattern continues, then some of these markets won't feel a dip at all. They'll just continue to grow, because for some metro areas, it's still so cheap. New York, looking at Jacksonville, 51% cheaper in 2020, 43%. They're still going to do it, right? Los Angeles to Jacksonville, 66%, and only down to 63%. I don't know how many Los Angelians are moving to Jacksonville, but you can see why they'd want to. And the list goes down. So some of these markets are going to continue to expand because it's still cheap for some people, not the locals. It's not cheap for the locals, but it's cheap for out-of-towners. Some of the areas where there's been, the largest net domestic migration increases, we got Cape Coral at the top. That area is starting to soften a little, at least in the housing market, but I imagine it will just boom right back. Sarasota, Hartford, Connecticut, that surprised me. Salt Lake, that's starting to, there's increased inventory there, but again, I think it's just fear and it'll bounce back. Boise, Boise had a big run up. So that's an area I think will probably soften for a while. All right, migration losers. These are the areas that were losing more people: New York, San Jose, San Francisco area, Los Angeles, Seattle, Chicago. Again, very high priced places where people were locked in their homes and they were like, enough of this. I'm going to go to a cheaper place where I can go outside. All right, growing metros. It's interesting. Some of the best job markets aren't in the big cities anymore. They're kind of in the suburbs. And that's why we're starting to see, the suburbs are a great place to look, even though people are moving back into downtown. A lot of jobs are moving into the suburbs, so follow those jobs. So I thought this was just interesting to pay attention to. The total number of U.S. housing units out there is 142 million, total occupied 127, renter occupied 44 million, with 20 million of those being managed multifamily, and then single family at 17. So lots of renters out there. Okay, well, I hope this was helpful somehow.
So what would you just say is the summary of this discussion, Kathy? Would you say we're not expecting a huge crash in housing overall?
Every market's different, but if you follow the fundamentals, which are jobs, population growth, affordability, that it's, you look at a market like Miami though, and it's not affordable. It's gone up so much, but you've got New Yorkers moving there. So to them, it's affordable, and their businesses are moving there.
Yeah. I think Austin kind of saw a little bit of the same thing, where we saw so much in-migration from California, where if Californians look at Austin, it's still affordable for them, right? I don't know how much longer it has gone up a lot. I know it's gone up about 40% in Austin over the pandemic.
Yeah.
Super high, right? So I am seeing some kind of correction. I'd say about 10% average in Austin right now, but I'm not really seeing this huge dip beyond that, because a lot of people are thinking, we'll back to pre-COVID levels. I'm not seeing that happen even in Austin, even in an overpriced market like Austin yet. So,
well, I think again, it's like sticker shock. People are like, oh man, I don't know. And they're also waiting for prices to continue to fall. I think that's a lot of it. And when they continue to see prices going up, which has been the case in some areas, then, it's going to be like, do I want to pay more for rent or pay this mortgage and maybe refi later?
Right.
But I agree. I mean, there's repricing and multi and single family around 10% in a lot of those markets. But I would say those are markets where there was just a lot of buying frenzy.
Right. And with the buying frenzy in Austin, people were, even with just the, bidding up from the price that is listed, was already 10%. So I'm like, okay, that 10% is going to shave off for sure, right? It's got to come down, right? You're already overpaying over what the market is really, because you're in, bidding war with 20 people. So yeah. It's just, I told people, a lot of people were trying to buy last year that, hey, don't be surprised if you lose 10%. It's just how it's going to be. You bought at the peak of the market, literally. So, yeah. All right. So
we're actually going to, it's interesting because I've been looking at multifamily just to see what, a lot of stuff comes across our desk, and I have not been impressed with the returns. But so we're actually going to do a single family fund, because we're seeing better returns there. We'll be able to get discounts and the rents are high. So that's what we're focused on for this summer.
That makes sense though, because obviously that's another reason why build to rent has also been successful, is that people want more space, right? They just want
Yes.
to spread out. And
Mhm.
compared to multifamily, like traditional 3-story multifamily, we are seeing a lot more people go for build to rent kind of products. So,
Mhm. Yeah.
or what would be really a collection of single family homes. So yeah, I think with that, let's look at some questions which came in. Harish asked, are you seeing a slowdown in Austin in multifamily and single family? I expect prices to soften a bit in single family, but multifamily will benefit from a drop in purchasing power. I can tell you about Austin right now. We are seeing softening in the single family, about 10-15%. There are some locations, though, that we had not seen any correction at all, like strong locations, even like sub-markets within Austin. I'm not seeing any correction at all. With multifamily, simply because the cap rates are expanding a little bit. We've seen about a 10% correction, I'd say, in Austin. In the multifamily. So definitely softening is there. And like Kathy pointed out, I don't think people can afford any more rents. There's a ceiling to which, you push rent. So unless you bought a property, a multifamily with low rents in place there, where, some lazy landlord has not pushed up rents all the way, there are those. There are always opportunities, even in a tough market, right?
Yeah.
We do believe in that. So we've had places where 3 years, some landlord didn't push up rents as much as they could have. They were still very not aggressive because they were already making the money. So there could still be opportunities, but it's definitely better to be careful in an overheated market, a market which has already done a run up, right?
Mm-hmm.
All right. What pandemic-related changes in the buy-sell process do you believe will become more or less permanent as we exit the pandemic?
I mean, some of the people just buying, rents, there's been a new process of not having to show the rental. I don't know if this was the case in multifamily, but in single, there were new kind of automated systems where you didn't have to have somebody showing the property. The tenant could just go in and look at it because there's cameras on and automated lock system. And so I think some of that technology will stay where you don't have to have the, the agent taking you around. Let's see what else. I think that a lot of businesses learned a lot over the last 2 years. We've been a remote company for 10 years. So we've had our staff all over the world for 12 years now. And that's helped us to hire the right person. It didn't have to be someone local. And I think a lot of businesses have learned that they can kind of expand who they can hire and found ways to be able to monitor how people work when they're remote. So I do see that as a trend that was already happening, but will continue.
Yeah, and to point to that, right, there are a lot of VAs involved, like virtual assistants in the buy-sell process that do all the transaction work on the back end. That went up even more during the pandemic, right? And I feel like that's just going to stay. It's not reverting back, right? Anything we shipped away is going to stay, if not grow. So,
and just learning to so many people ordering stuff. So industrial space, I think, is going to continue to be in demand.
All right. Arrive.com, Jeff Bezos, AcreTrader and Trelli have lowered the cost of investing in real estate, 9 to 13% returns, 5 to 7 year holding period. How do these companies compare with traditional REITs? And I guess they're talking about these online investment platforms, right? Like Chatter and Arrive. I don't know about Arrive.com, but Trelli. How do these compare to traditional REITs and private RE funds? Are these the new CDs?
Well, I think that is a trend where you don't really have to have a broker. I mean, you could on your phone on Robinhood, you can just pick a stock and sell it in a click. So it's not surprising that would come into the real estate space as well. I think, just knowing my nephews who've been playing a lot with that and have just gotten absolutely just like hammered over the last couple of months, I think people are going to say, oh, maybe I need someone to help me manage this instead of me trying to figure it out myself. So I don't know. We'll see. I just know our business, in spite of the fact that there's real estate agents nationwide, we've always been busy because we would offer, white glove service, really, really walking people through the process. So there's some people who are able to just go on a crowdfunding site and buy a share. And there's others who really need to be handheld. So there'll be both.
Yeah. And I want to add to that a little bit. Like I have numerous investors have asked me this. It's like, hey, why wouldn't I go on Catter.com or somewhere and invest in real estate, right? There's like a couple of points that I want to bring up. One is there's only so much. I mean, they do vet these sponsors before they allow them on the site, but you really don't have a personal connection with the sponsor or the syndicator there, right? So there is no real knowledge of who it is behind the scenes. So I personally started with one of those websites. This has been around for a while, right?
Yeah.
15 around there. I started and I had one great investment that returned on time. They actually returned before time and returned my capital, which was too bad. I wanted them to hold on to my money. There was another which they went bust during this whole crazy 12-year run up. I'm like, how do you do that? So I never got my capital back. I lost all of it, which was a pretty small amount, like 10,000 or something. So they were doing retail in Nashville. I'm like, how do you lose money in Nashville?
Yeah, right.
The crazy run up. So I think a lot of the deal, I think it's not just about the location and the asset class, it's also the sponsor. And I don't feel like I get a good chance to vet the sponsor on these platforms. And I just have to go by what I read about them, which is, who knows? So that's personally been my experience with it.
Yeah, I won't say the name, but there is a platform also that, for single family like that. And the people that we work with kind of put their stuff up on there that they can't sell, So you still have to, no matter what, it's your money, you got to do your due diligence.
Right. And at the end of the day, location's great, asset class is great, all of that stuff is great, but who is handling the deal matters. Like the sponsor is the most important part of the equation for me, right? That's my learning from investing passively.
Yeah.
So the question is, what about 2022 data? Things have changed post 2021. I thought there was a lot of 2022 data. Maybe some things were pre 2022. I don't know.
Don't think so.
I think, most of them are like May 2022, I believe.
Mm-hmm.
All right. As baby boomers age retire, do you see a spike in the reverse mortgage activity?
Where's that one? Oh, as boomers retire, do you see maybe, possibly. Yeah.
I mean, they have equity. So
yeah,
sitting on equity. Yeah.
Yeah, I could see that.
The 1% rule is a memory and rent multipliers are beyond 10x. What is the new rule for measuring the investment quality of SFRs?
That's good. The 1% rule, I wrote about it in my book and I'm rewriting my book and revising it. And I took that out. I'm like, this is just not even true anymore.
You can't buy anything.
Yeah. Well, and also what we learned over the years is that it's just kind of a way to look at a property and know, should I look at this or not? The price rent ratio. Should I dig into this further? Obviously, if I'm looking at and I'm talking California talk, but a very cheap $500,000 home would be California, and it rents for $1,000. Obviously, you're just not going to look at that. So it's just a way to sift through things faster, is to see the percentages. But what we learned over the years is that certain markets that I would pass because they didn't meet my rent ratio, and I would go to other markets. When I looked in deeper, there's too many factors like taxes. If you're in one area that has really low taxes, and comparing the rent ratio to one that has really high taxes, at the end of the day, it's the cash flow that matters, right? So that's that. I stopped using that. I use it more as just, I'm going to look, but at the end of the day, it's the expenses. Even a new home, if you buy a new home that it has lower insurance, it might not look like it cash flows year one. It probably doesn't. But then when you really look over a couple of years or 5-year plan, there's less repairs, everything's new, and you have lower insurance. And if you buy a home like that in a low property tax market, then it might be better than a high cash flow market in Ohio, because I bought those too. And boy, after you have a roof repair or got to upgrade the plumbing, it's your cash flow is gone.
Right. Yeah. Same in Austin, right? After you pay 3% in taxes, your cash flow is over.
Yeah. So you just can't use that rule anymore. I mean, just put it through a pro forma and that'll tell you.
Right. All right. Can you please repeat your comment on do not over leverage? I'm not sure what that comment.
I'm just, there's a lot. I don't know what you do. What's your LTV max?
So we are right now like in the 73% range on most investments. We did like 65 on one deal a couple of years ago, but we are definitely going in around 70 right now.
Yeah, I wouldn't personally go over that. So that's what I meant by over leverage. And on single family, it's different. I would certainly go over that on the single family, but on multifamily, I'm being cautious. Because if it's repriced, you're going to have to come in with more money.
Right. And the other thing in multifamily, I think we are being a little cautious about is, we can't always get into fixed rate debt, just depending on the apartment that we buy. Mm-hmm. So we are buying caps on the interest rates, and we are also setting aside, lenders already taking a year worth of reserves, interest rate reserves in ahead of time right now. And then we're also setting aside money to buy another rate cap if needed at some point, renew the rate cap. And we're setting aside reserves for interest rate increases, factoring that, hey, Fed's going to push this some more. So I think in addition to, like Kathy pointed out, cash reserves are really, really important right now. Super important. So. All right. With manufacturing jobs based in Austin, with companies like Tesla, Apple, Applied Materials, shouldn't the city retain more people compared to cities that are suffering because of work flexibility, say in IT?
I mean, that's wonderful. Austin is it's a unique and special place. You're lucky to be in that market. There's a little bit of everything there. So, it's just had a massive run up, and I would be cautious about thinking that values are going to continue to rise right now, or that rents can still be pushed right now. Over time, over the long term, I can't see how it wouldn't. Yeah, because it just keeps growing. But there's a pause there right now, I would say. But that might mean you'll find some deals.
Yeah, hopefully maybe next year, once we've had this interest rates push, I'm thinking, okay, if there's a better correction, there might be a good entry point into Austin. Personally, that's what I'm hoping will happen, right? Yeah. So a correction is not such a bad thing because it'll get more investors coming into Austin. Because like the person who posted the comment pointed out, we've had about, $17 billion put in by Samsung, which we thought was like, oh, that's it. Okay, that's a pretty big investment. But, we didn't realize now they're going to put another 200 billion million into Austin. And then following them, there's a whole bunch of people coming in, setting up manufacturing facilities in Austin. So we are kind of shifting from IT to manufacturing, which has been very interesting for Austin. So we'll see how it all pans out, but I don't see, like you pointed out, I don't see Austin growing at the pace that it has. It's just unsustainable. It cannot grow. So
it's not healthy.
It's not healthy. No. What's your take on new construction and multifamily, also known as the build to rent model?
Build to rent, single family or multi? Looks like multi.
Build to rent, multi. Build to rent is more like a single family, multifamily kind of hybrid, where you do like a whole bunch of like, we're building 2 communities in Austin where we have 150 homes, but they're single family homes, but they'll be built like 1 level. So we don't have a typical 3-story multifamily. So we rent the entire community as a rental community. So it's like a hybrid between multi and single. It's definitely growing, and I see a lot of capital coming into that particular sector. A lot of hedge funds are interested in BTRs, built to rent, or BFR, BTR. You'll see the words used interchangeably. A lot of hedge funds money coming into that sector. So I think it's, as Kathy pointed out, single families are more desirable than renting multifamily, given the price point, let's say, is maybe a couple of $100s. So we are definitely seeing more interest in the build to rent model.
Yeah. I agree.
What do you suggest, recommend for those who are currently into good investment properties but located in areas going through bad, going bad due to locals behaving out of fear, and what has been going on in the media and the world?
Have good investment properties, but located areas.
If it's good, how does it matter? Just
I'll just focus on the cash flow and don't worry about it, because if it's a good market, it's going to come back.
Yeah.
In the meantime, you're paying down your loan, and
yeah, as long as you're cash flowing, even if it's a minimal cash flow situation, I'm like, ride the downturn, right? This was fantastic. I agree. As Texas property taxes lower my rental profits, will review your websites to keep winning in this market. Yeah, unfortunately, Texas property taxes keep lowering everybody's rental profits. So we keep fighting and protesting them. And I really think next year we're actually going to see a little correction in the property taxes. The cities will have to pull back. They have been so aggressive. They increased basically all the tax appraisal rates around 30-40% this year.
Oh, yeah, that's brutal. I think people are going to push back and do what we have done here in California, putting caps on it.
Yeah, I think there's going to be something like that happening, or next year they'll have to start pulling back because prices are pulling back. So
yeah.
For people who own existing properties, hey, that's not such a bad proposition. If you can pay less taxes, now you increase your cash flow because rents are not going down.
Yeah. Yeah.
What's your take on investing in short-term rentals? Convert long-term rentals to short-terms.
Short-term rentals are amazing, especially if you can get into the 30-day ones with the nurses are pretty fantastic. It's just some areas are really saturated because now you've got lots and lots of people teaching online how to do it. And I just talked to somebody who had a really great performing short-term rental, and all of a sudden there's like 10 rentals around them. So they're now she's trying other things like Peer Space is a service I use where photographers will just come and use your space, for the day. So anyway, just make sure you know your competition and understand the local rules, but it can be extremely lucrative in the right place.
Yeah. And one of the resources I got was to look at airdna.com for short-term rentals. Yeah. They really have very accurate data on where, the best short-term rentals are, where there's like still a supply-demand sort of gap. So you can actually get a good rate on the short-term rental. It's not an oversaturated market. So sometimes it doesn't make sense to convert it. Sometimes it does. Like I had a long-term rental that I was looking at, hey, maybe I can convert. It did not make sense. The rent differential between the short-term and long-term, given the expense increases, the handling and headache of managing a short-term rental, I'm like, it doesn't make any sense. For like $400 more, I'm not going to go through this headache, right? Yeah. So you kind of have to evaluate those factors before you jump into short-term rentals, because a lot of these things, a lot of these education people make it sound so sexy. It's like, yes, short-term rental, you're going to retire rich and you're done, So yeah.
Okay. Top 5 cities. Yeah, I would say the Southeast is still growing. So, the Carolinas, Florida, I like Central Florida, parts of Alabama, Georgia, that those are desirable for both, West Coast and East Coast people. So I think that If I were to choose a city, Jacksonville just keeps coming up on the list of growing cities and any suburbs around it. I do like out the suburbs of Charlotte. That area continues to grow. I like Salt Lake. I think that continues to grow. They make a lot of babies there. It's growing.
All the Mormons.
What about you? I mean, obviously Austin's a great place if you can.
I wouldn't recommend Austin to invest. I've been dissuading investors from investing in Austin for the last few years. And I'm like, go away and go invest in San Antonio, right? It's a market, I think, which is still low on rents. But still affordable is San Antonio, one of the major cities. So the prices are still low, and you can get close to like maybe 0.8% on the return, like the long-term, what do you call the percentage, right? Not 1%, no 1% rule, but 0.8% rule. And for me, that's pretty darn good.
Yeah, these days, 0.7 is pretty good.
But I think I would stay away from cities or places which have really high tax issues, because it just kills your profits all day long, right? So I like Georgia, I like Tennessee. Parts of Tennessee are really good. Like Knoxville has done really well, Chattanooga. So I still think there are opportunities up there.
Definitely.
Awesome. I think we'll wrap this up. A lot of questions. And thank you, Kathy, for going over time and sharing all this data with us. Very insightful. I walk away feeling a little bit more like, okay, it's not so bad.
Everything's going to be okay. Yeah.
Just the market, like you read headlines, you just like lose sleep over headlines.
Absolutely. It's terrifying.
But
all right.
We'll have you on. Thank you so much for your time. And have a good night, everyone. Thank you.
Take care, everyone. Bye-bye.
Thanks for joining in. Bye. Hi, I'm Kavita Bhartake. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.